Okay, folks, welcome to part one of this video series on what is a strangle and how am I already up in one day 12% on this trade. I'm going to show you the trade execution. I'm going to show you the trade in my brokerage account. I'm going to show you the chart. I'm going to show you the whys of why we got involved with Amazon. And I'm going to show you exactly what a strangle trade is. And to be a little bit more specific, this is a ratio strangle trade. Now, I went over this last night on Sunday Night Futures Live. This particular strategy using a strangle, which is the sale of options, not the purchase of options. We want to be the banker. We want to be the casino, not the gambler. We want to collect premium cash flow. So let's do a quick follow-up on what we discussed last night. I'm going to link to last night's segment on this Amazon trade at the end of this video. So let's recap. Amazon ratio strangle. A typical strangle is when you sell to open the minimum one call contract, simultaneously sell to open one put contract. In this case, we used a December expiration, December the 16th. 47 days till expiration. This is as of last night, so it's actually 46 days. Probability of profit. This has changed. This is now more like 80% because we changed how we would set up our strikes because the shares of Amazon didn't do exactly what we had expected them to do this morning. So we're a little bit more conservative with how we selected our strikes. And I'll share that with you. Now, this is a neutral strangle, meaning the number of options sold are the same, both to the call and to the put side. However, when you're doing a ratio strangle, that means that you are somewhat biased in the direction of which way the stock is going to move. In this case, we are short biased. Amazon reported poor earnings. Their stock got hammered. It appears as though, in all probability, in our own opinion, we'll go over the chart in a moment, that the shares will, in all probability, move lower in the next couple of weeks. So what we did to take advantage of that short bias is rather than selling one call, we sold two calls. I'm going to pause there because many times people hear call options. They believe that it's a bet that the stock is going to go up. That would be correct if you are buying the call option. In this case here, we are selling to open the position. Again, we are the casino, not the gambler. We want to collect the money. We want to collect the premium. We do not want to be buyers of the premium and then hope that the shares move in the direction that we want. We have roughly an 80% probability of profit. While yes, our upside is limited, the probability of making consistent profits is very, very strong. And to continue on with what a ratio strangle is, it's to also sell to open only one put contract. Why? It's because we believe the shares are going to move lower. If we're proven right, well then, that one put contract is going to become more valuable and the two call contracts are going to become less valuable. Same December expiration. And again, the probability of profit here is at about 80% because we adjusted from last night when I prepared this slide where we would place our strikes. And again, we were more conservative with the opening trade. Now, the return on capital, it'll be about the same, perhaps a little bit less, 8.6% on a neutral, typical, traditional strangle. In this case here, slightly less in terms of a percentage return on capital, but in dollar terms, you're collecting a greater amount of premium to place into your bank account. So let's walk through how this trade looks. Okay, so here's the actual trade execution. Let me maximize that. So you can see here that Amazon shares expiration December the 16th, 2022. We sold to open three contracts, three put contracts. The strike that we used were the 83 puts. Simultaneously, we sold to open Amazon December the 16th, 2022. Sold to open six contracts, twice as many contracts as puts, twice as many call contracts than puts. You can see we were filled on this order. The credit received was $2.37 per contract. Now I'll show you how to enter this trade and what it looks like in our brokerage account at current. Okay, now let's take a look at this trade in my brokerage account. This is a Street Smart Edge, Charles Schwab. And up here you can see here's the options trade. Our Amazon, December the 16th, 125 calls. We have 6 contracts. Amazon, December the 16th, 83 puts. That creates our Strangle. Now, the premium collected here on this trade was $705.03. The current value of the trade, if we wanted to close it out right now, is $613.50. So that shows us a profit at current of $91.53, or nearly a 13% profit in a few hours of work today. So we could close this out for a profit if we'd like to, but I think there's still more meat left on the bone. And I'll share with you in a moment why we saw a profit so quickly on this trade, because it doesn't always happen. Before we go to the reason as to why we selected our current strikes and discuss the probabilities of profit, let's take a look at how we entered the trade. So let's expand this out. Now, unlike a trade where you're buying options, we're not going to buy to open here, right? That's what you would do if you wanted to get long and own the options for unlimited upside or unlimited downside. But in this case here, we're going to take limited profitability, meaning we know exactly what the maximum amount is we're going to make on this trade. And the trade-off is that our probabilities of making that money are much, much higher than the option buyer. So our probability of profit on this trade is around 84%. And I'll show you how we arrive at that in a moment. So we sold to open 3 contracts of the 83 puts expiring December the 16th, simultaneously selling 6 contracts. That creates the ratio. If you're going to do a standard strangle, this would be a 3, and that makes you neutral. However, in this instance here, we are bearish. So we're going to add on more calls. Let's bring this down to 3. So 3 put contracts, 83 strike price, simultaneously selling 6 contracts, 125 strike, December the 16th, expiration. Now you look over here, this is your delta. And in a moment, I'll explain to you what this is. This is what you call a 10 delta trade. It was 10 when we opened it up, but by the end of business today, it was only a 9 delta. Keep that in your mind. I'll go to that in a moment. And you would normally just click review your order, make sure it's right. It's easy to make a mistake here, then place your order. I'm not going to place this because we're already in the trade. So that's how you enter it. Sell to open, number of contracts, strike selected. Now we're going to talk about what a delta is. What is a delta in options trading? It's one of the Greeks, okay? So in your options trading business, you're going to want to know what your Greeks are. You have Vega, Theta, Delta, so on and so forth. Right now, we're going to concern ourselves only with Delta. And Delta measures the rate of change in an option's theoretical value for a $1 change in the price of the underlying security. So let's put that into practice. For every $1 move at current on Amazon, the change for a 10 delta would be 1 dime per dollar, or 10%. Now, if it was a 20 delta, it would be a 20-cent move or a 20% move for each dollar change. 30 delta, you can get it now. A 30-cent move or a 30% move for every dollar change, so on and so forth. So that's how we calculated where we were going to place our strikes. We wanted a very, very high probability of profit because the charts had yet to see a new weekly lower low. I did not have time to be sitting in front of my computer all day long. I had other things to do. So I wanted to make sure that we were conservative with our opening trade. That way we can go about our business. Now let's take a look at how our probability of profits look on Thinkorswim. So we use this functionality. This is the Analyze tab in Thinkorswim. Amazon, the symbol, probability of trading in the money by options expiration. A less conservative play here would be a 1 standard deviation move or a 68.2% probability of profit. In this instance here, I said, you know what? Again, I don't see a breakdown yet. This is a directional play, meaning bearish. So for now, I'm going to be a little bit more conservative. We can always adjust our strikes in the future. So what I did was I went to okay, so now we've adjusted our probability range, 10 delta, which is an 80% probability of profit. I think I said 84% before. I misspoke. An 80% probability of profit. So here's our strike, just as we have it, or I showed you on the trade platform. Our call side is at the 125 strike. Expiration, December the 16th. You can see it down here. Our put side is at 83, slightly above where we're at right now because the shares were under pressure today. So this changed a little bit, which is to be expected. But I think you get my drift. We're in the ballpark of where these strikes are, a 1 delta move or an 80% probability of profit. Now, if I was really confident with the direction of Amazon, I probably would have went a little bit more aggressive to a 1 standard deviation move. That would have been a 68.27% probability of profit. You could see my call side strike would have been considerably lower, and my put side strike would have been considerably higher. But I'll take conservative over aggressive any day of the week because you need to be able to sleep at night. Now, what I want to address is this. I want to address the 13% profit in one trading day because the share price, while down when we opened up the position, really didn't move all that much to warrant a 13% profit in a single trading day. So what happened there? Why were we gifted with the 13% profit in a single trading day? Well, as I mentioned last night on Sunday Night Futures Live, you need to only trade or sell premium on options that are expensive. Because not only do you get paid for time decay, you also get paid for what you call IV crush or implied volatility crush. Because it's the contraction of implied volatility that gives you an extra added bonus when you're selling premium. But before I show you how to identify how to find those options, well, the first thing you need to know is what drives implied volatility higher. In short, it's the demand for the options by speculators. So earnings are in the rearview mirror. So the speculative money flowing into the options is beginning to dry up a little bit, but they're still pretty expensive, but not as expensive as last night. Now, last night, on your upper right of your screen, you should see last night's current implied volatility. It's showing as being 57%. By the close of business today, implied volatility was only 53%. So that contraction in volatility reduced the value of the options. This is the edge that you have over other options traders. This is why some options buyers, they scratch their head. They can buy an option. The share price doesn't even move that much, yet the value of their options declines. Or even worse, the option moves in the direction that they want the option to move, yet the value of their option either A, doesn't expand in value, or B, actually contracts in value because you have time decay and implied volatility attacking the value of that option that they purchased, which is why we like to sell premium. Now, looking at the chart of Amazon on a weekly time frame, you can see that Amazon is holding on to a support level. We do not have a new weekly lower low. And as technicians, that's important to us if we're going to take a directional bet on a stock or a currency, a commodity, whatever we're trading. We want to see, if we're bearish, we want to see new weekly lower lows. We want to see that trend continue. I may be a contrarian, but I do respect the trend. So we may go adding more to this position if we see a breakdown below $100.38, which is the support level that we're currently defending. Or I can keep the same position size on, meaning 6 call contracts, 3 put contracts. But if the shares break down to new lower lows and those call side options begin to show us a big profit, well, we may just close out that call side profit, roll down in strike and reestablish that call position at a lower strike, but still using a 10 delta. We're always going to want to measure our probability of profit. And if we do that, I'll show that to you at some point in time down in the future. I don't want to confuse you right now. I want to keep this really simple. So if you're not currently subscribed to my channel, please do so. I'll be doing follow-up videos on this trade, whether we make money, lose money, roll the trade. We're going to follow this trade through to the very end, so that way you become more educated on what we do here at the Contrarian Trader. If you like this video, please, again, like, subscribe to the channel. Leave a comment below if you have a question. I'll be more than happy to answer it for you. If you're new to technical analysis, I have a 5-part video tutorial linked below on my top 5 favorite candlestick patterns. Please take advantage of it. We are using TrendSpider, our automated technical analysis software. There's a link below, 35% discount code. Pay attention to that. They give a 7-day free trial offer. I believe in it so much that for a limited time now, I will be giving it away free to silver and gold level members. So act quick, take advantage of our 14-day free trial offer to the Contrarian Trader, because this trade was sent out this morning to our members in our forum. You can see here, this is the note, Amazon ratio strangle, bias short. I went more conservative than last night. Small size and a 10 delta on each side, which is roughly an 80% probability of profit, which is everything we already went over this evening. Again, like, subscribe, leave a comment. Thank you for joining in. I'll talk to you soon. Be well. Okay, we want to do an Amazon ratio strangle. So this is a trade that we would expect to get on a typical strangle. What's a strangle? Okay, let's define what a strangle is. A strangle is when you sell, very, very basic, sell one call, at the same time you sell one put. Same expiration date, and what we're looking for here is an expiration date going out 47 days to expiration, DTE. The strike is the December 16th strike. We expect to make on this trade, if we hold to expiration, 8.6%. Now, it doesn't sound like a lot of money, does it? But for 30 days, that's a lot of money. You multiply that times 12, you're dealing with a lot of money. But to hold it to expiration requires a lot more risk. And you're not getting paid for all that much risk. The longer you hold an option towards expiration, the greater your risk of your strikes being challenged. And let's take a step back first. We don't plan on buying these options. We want to be the banker. We want to be the casino. We do not want to buy the option. We want to sell the option. I'm going to go to the reason why we selected Amazon in a moment. We're not there yet. So our game plan here with Amazon is to hold it to either A, 50% profit, which is a 4.3% return on capital, and or 21 days, which should get us roughly 50% profit, or a 4.3% return on capital. Pretty good. You do that every month, you're making real solid cash flow. But that is a typical strangle. I'm bearish on Amazon, so I want to put on what you call a ratio strangle. It's pretty much the same thing. Same expiration date, same probability of profit, POP, probability of profit, 70%, not bad. That's what you get when you're a premium seller. You don't get that type of odds when you're a premium buyer. So in this scenario here, we're going to collect less in terms of a percentage gain if we hold it to expiration, but we collect more premium. $373 versus $266 for your standard strangle. What's the difference between the two? Simple. I sell twice as many calls than I do puts, right? So if I sell a call, that means I am bearish on the stock. I want the stock to go down. If I'm bullish on the trade, I want to sell more puts, and I want to lighten up on call, if that makes sense. If you have a question, I'll stop. Ask your question. I indulge you to please do so. So again, we are selling premium here. We ideally don't want the stock to do anything. We want it to expire worthless. If TrendSpider is between now and December the 16th, that's great. Option buyers don't have that luxury. They need the stock to move. Let's talk about the trade. So let's bring up Thinkorswim and go to why do we like Amazon? And in reality, you could apply this to Google. What we're looking for here are, this screen here shows me expensive options on a relative basis. Relative to their past 12 months, are the options expensive? I only want to sell options where I get above average premium because I'm looking for IV crush, implied volatility crush. So I'm looking for an IV percentile on a stock that is not going into earnings and has an IV percentile above 50. Above 50 makes it expensive on a historical basis. So let's scroll down. What stocks do we have to choose from? Google's one. We may choose Google, but in this case, we're going to select Amazon. Why? I hate the chart. So let's go to Amazon. Amazon, does it fit our criteria on the trade platform? Yes, it does. 54% current IV percentile. So what's the trade here? Here it is. I already have it laid out. We're going to sell to open. This is the ratio. 2 contracts. Amazon, December 16 calls simultaneously. We're going to sell to open 1 contract. Amazon 16 calls. The strike price to the call side 122. I'll show you what that looks like in a moment. And to the put side an 88 put. That'll generate us a premium of $3.73, and you can see you multiply that times the minimum of 100 shares, 1 contract, that brings you into your account, deposited into your account, $373. Not bad. So what's the probability of profit here? We kind of already went over that, but let's visualize it. Here is December the 16th. We're using a probability ratio of around 70%. We're selling the 122s. There's a probability of 85% that these shares will trade below 122 by expiration on December the 16th. There is also a 85% probability that these shares will trade above $86, right? That's what we had it. $88 on the 16th of December. So the probabilities favor us dramatically. So this is the trade that we're looking to put on, and you can adjust this if you're neutral on the trade. You really don't have a bias one way or the other. Suppose that Amazon met earnings expectations. It really didn't do much after earnings. Didn't break down. Well, I would just change this. I would just sell 1 put, 1 call it a day. You're going to collect less premium. Now that premium is only $266. If you're going to trade 10 contracts, sorry about that noise. If you're going to trade 10 contracts, well, you multiply that times 10. That's a trade on Amazon. Let's do some chart requests.